hello to those of you watching this remotely. What we will be doing today is going over Roman numeral 3 in chapter 17, and that is job order costing. So we'll be going over journal entries and T accounts. And as you know, you have the outline in a handout, but there's an additional handout which has the solutions to what we'll be doing for the example in chapter 17. I sent that to you in your email, but it's also on Canvas like all the other files are. All righty, let me go ahead and start sharing my screen. So here with job order costing. So as I said, we'll be dealing with journal entries and T accounts here in the chapter. And by the way, all inventory accounts which contain product costs have normal debit balances. Cost of goods sold is an expense and thus will have a normal debit balance as well. So I'll go over the rules for debits and credits in just a little bit to refresh them. But I think you probably remember this about inventory and this about expense. Well, both normal debit balances. So the debit or left-hand side is the side that will increase both an asset, inventory being an asset, and will also increase an expense. Now, before I do get into that though, let's look at B. Well, traditionally product costing was under either a job order system or a process system. Well, job order costing, which is what we'll be doing today, was traditionally used for products which are high in dollar value or which are custom made. And product costs are accumulated by the job, which is one unit or a batch of similar units. And note the analogs of job order costing are perpetual inventory, where we keep track of it all the time, and the percentage of completion method for construction. If you take intermediate level financial accounting, you'll get into that then. And automation also makes all three of these easier today. But job order costing is where we continually track that job as it goes down the assembly line. So as we add some direct materials to it, we'll add those to the job cost record. So the job cost will increase by the cost of those direct materials. As we add some direct labor, well, again, the cost of that job is going to increase by the amount of direct labor we've had. Same thing for our allocation of inventory, which we'll also get into today. So we continually track that job, and that's a good thing. And of course, automation, having a computer makes this a whole lot easier. For example, as we add some direct materials to the job, we can scan the barcode on it. As our direct labor workers begin work on the job, they can scan their employee ID badge. Then as they stop, they can scan it again. Now we know how much time each employee spent and multiply that by the wage rate. We have direct labor cost, etc. So job order costing, that's what we'll do. However, there is another type of costing, which is called process costing. And that's used when units are extremely similar and they're produced continuously. And process costing assigns product costs to individual units by an averaging system. And this is usually more efficient for such a process. For example, if we were manufacturing something, let's say that we were manufacturing bags of potato chips. Well, if we were, it would not make sense to track each bag of potato chips as it goes down the assembly line and continually track the amount of direct materials going into it, the amount of direct labor going into it, the amount of overhead going into it. Just doesn't make sense because all of these bags of potato chips are identical. So we may as well wait until the end of some time period and then total up all the direct materials, all the direct labor, and all the overhead during that period. Then we'll divide by the equivalent units that we produced. So that's something, again, we would get into in cost accounting, upper division cost accounting, which is just to let you know it's out there. Publix, for example, uses that for all the consumer products they make. And they wait until the end of either a 4-week period or a 5-week period to total up all these manufacturing costs and divide by the equivalent units of production. They actually have 2 periods of 4 weeks, followed by a period of 5 weeks. Why do you think they use a so-called 4-4-5 system? Add the weeks up. 4-4-5. Exactly. Every 3 months. You got it. So each one of those 4-4-5 week periods is a quarter of the year. And number 3 will also say something called activity-based costing in the next chapter. It's kind of a combination of the two. Well, looking at, see here, in job order costing, the cost of each job is accumulated as it progresses through production, as we know. Each job is assigned a job cost record to continually track its cost. There's one in your book, but I'm going to show you one up here on the board in just a second. And the job cost record shows the dollar amounts of direct materials, direct labor, and overhead the jobs accumulated to the present time. And we can note the job cost records of uncompleted jobs for the subsidiary ledger for work in process, and the job cost records for completed jobs not yet sold for the subsidiary ledger for finished goods. So for example, if we want to know the total dollar balance of work in process, we can simply add up the job cost records of the uncompleted jobs sitting out there. Likewise, we want to know the total dollar amount of finished goods inventory, add up the costs of the finished jobs not yet sold, add up those job cost records. So those are the subsidiary ledger. And of course, job cost records are easily automated. Spreadsheet will do just fine. And there are programs that we can get, manufacturing cost accounting programs, so that we can already have job cost records set up for us. If not, we could use an Excel spreadsheet. So here's an example. I'll show you how easy it is. We're going to calculate the total manufacturing cost of a job, which is consuming $600 of direct materials and $300 of direct labor. And the predetermined overhead allocation rate is 30% of direct labor cost. That's given to us. Don't worry about those 7 steps. I shouldn't have really put that on there. It seemed like I did at the time I typed it up. So let's take a look at a job cost record, and let me stop sharing for just a minute here as I do so. Whoops. All right. Okay. Let me do it this way. Okay. Okay, so I make use of my little bit of space where I am between here, between these screens. And obviously I'll have to put these screens up in a little bit, but that's okay. Anyway, for right now, let me share this job cost record with you. And for those of you in class, let me do this. Okay. expand that. Also, for those of you in class and those of you online too, I should say this, for the additional handout I mentioned to you that has the solutions, the chapter 17 examples we'll be doing, it looks like this. Yeah, I emailed it to you and it's also on Canvas for you. So right here is going to be the job cost record. In fact, probably easy enough to do it just from here. Okay, we're told that we have, oh, hang on, let me just go back here. Sharing my screen, sorry about that. Okay, so the additional chapter 17 handout with the examples right here looks like this. And here's the job cost record. So we take the direct materials of $600, we're told. We add to that the direct labor of $300. Then the overhead allocated. We're going to take the $300 of direct labor because that's the cost driver, the allocation base says. Multiply by 0.3, 30%. That's the allocation rate, 30% direct labor cost. When we do, we get the manufacturing cost of this job in total of $990. So that's how much it costs us to make that job. So now, as you can imagine, as this job transfers from work in process inventory to finished goods inventory, work in process is going to go down by $990. Finished goods inventory is going to go up by $990. Then when we sell it, finished goods inventory will go down by $990 and cost of goods sold will go up by $990. Any questions on that? It's easy. By the way, I didn't intend for this to mean something, but the number 990 actually does. The 990 is actually an IRS income tax form. And well, there's a lot more information than just income tax information, but a 990 is the income tax form that a not-for-profit organization fills out. Now, it may seem as though they shouldn't have to fill one out, but yes, they do have to. Florida Southern does too. So here at Florida Southern, we have a 990. It's about 100 pages long. It's very complicated, but it makes sure that we are not-for-profit and make sure that a lot of things about us will be disclosed, including, for example, what our trust funds are that donors have established for us. So a lot of the information's in there. And if we are making a profit, that's when we would get taxed. So I hope that doesn't happen. That's an IRS form 990. All right, let me go back to the outline itself. And as we look here in E, we're going to have an example of some job order costing journal entries. So we'll assume the following occurred during the month. So I'll get to that. And before I do get into there, let me go ahead and review with you the rules for debits and credits and also some stuff about journal entries and T accounts. So what I'll be doing as I go over this, the 9 entries we have, I'm actually going to be putting these screens up. And the reason I do need to do that is because I need the board space, obviously. So let me go ahead and do that. Okay. those of you on screen, I'm going to stop sharing my screen. All right, so as we think back to last semester to financial accounting, this is going to be a little bit slanted. If you're on a computer screen, you're online is because I have a wired connection up front, and my wire isn't very long, unfortunately, so I can't move this any farther over to the far board over here. I'll make sure that I keep everything in focus. So let's think about the rules for debits and credits. First of all, what does debit mean? Anybody remember? Pardon?
Yes,
Depends on what you're talking about, right? Depends on the account. But there's a very specific rule for what debit means. Very simple. Remember? No. Simply means what? What does credit mean? Right. Yes. So as we think about the rules for debits and credits, well, I usually think of accounts like I'm going to draw up here on the board so that I can remember whether a debit increases that account or whether a credit decreases that account. It just depends on the account. So if we think about account type, and we think about debit or left, you can let DR equal debit. And if we think about credit or right, CR stand for credit. Okay, good. Yeah, I apologize there on the screen. It looks slanted. Well, it is. Let me bring up debit there just a little bit. So if we think about assets, liabilities, equity, revenue, and expense. And finally, dividends. So an asset account. Well, we just said a little bit ago, one asset is going to be represented in the form of an increase by, it will be by which type of entry, debit or credit? Debit, you next. I'm just going to put a little plus sign there by the asset. So just like we have on the balance sheet, asset, liability, equity. Now, if we think about which side increases a credit, so I'm sorry, what if we think about which side, debit or credit, increases a liability? So for a liability, would a debit or a credit increase that liability? Credit, exactly. Going to be the opposite of liability. And obviously, well, a debit would decrease the liability, and a credit is going to excuse me, decrease in asset. Now, if we go on down the balance sheet to equity accounts, so stock, retained earnings, which side is going to debit which side, pardon me, is going to increase an equity balance, a debit or a credit? Credit, you got it. So this way, we've got the three types of balance sheet accounts up there. Assets on one side, equities, and liabilities on the other side. Does that make sense? Opposite sides of the balance sheet. Then on the income statement, what is going to increase a revenue account, a debit entry or a credit entry? Credit, yes. Which makes sense because if we increase a revenue account with a credit, well, ultimately revenues are closed out to owner's equity. So a revenue will increase an equity account. So it makes sense they're on the same side. When it comes to an expense, which side is going to increase an expense, a debit or a credit? Debit, you betcha. The opposite of a revenue, that makes sense. And dividend, when we pay stockholders, would a debit or a credit increase it? Debit, you betcha. So dividends are really not expenses, but they behave like. In the end, both dividends and expenses are going to decrease equity accounts, specifically retained earnings. So it makes sense that they're the opposite of an equity account. So as long as you remember those rules for debits and credits there, you'll be okay. Then when we do journal entries and T accounts, we also reflect debits and credits there. If we think about a T account, let's say any inventory account. We remember, of course, inventory is an asset account. So if we know the type of the account, good. Now, if we were going to increase inventory, we're going to enter a number there on the debit side. So we drew this T account. It's so called because it looks like a big T. And any debit, we put there on the left-hand side. Any credit, we put on the right-hand side. We put the number that we make a journal entry for. We'll be making some journal entries right now. But as an example, if we were to buy some inventory, if we buy inventory, we purchase it from a vendor, we're going to be increasing our inventory account. Generally, back in 2111, this was just merchandise inventory for a retail. So if we buy, let's say, $1,000 worth of inventory from a vendor, we're going to be increasing inventory. So again, we are going to debit that account. So it would look like this. Usually, we would be giving that vendor a promise to pay, meaning an account payable. An account payable is which type of account? It's a liability. So if we increase it, as we would do if we purchase inventory, we're going to do what to accounts payable? Debit them or credit them? Credit. So we recall the form of a journal entry there. And in that, see okay on the screen. So as we do, we're going to represent this debit here by something over toward the left. We have the account title toward the left and the dollar amount toward the left. For accounts payable, we represent that with something over toward the right as we credit. So we slide that title over to the right, and also that dollar amount we slide over to the right too. So I posted there the inventory part. I should say, by simply inserting 1,000 right there. That's going to increase the dollar amount of inventory. So we'll get some practice doing that here in just a moment. Any questions about what we used to do back in 2111 for debits and credits? Yes. Oh. Okay.
Sorry, I don't know what happened.
Okay,
I think
no.
my Wi-Fi
So I'm
disconnected.
not very good at watching chat. So if you have any questions, just let me know. Just shout them out. Okay. Okay. So for just a moment, let me share my screen. I'm going to go back here just to remind ourselves as to what E looks like. So here, oh, I should say in D, manufacturing cost flows in the book. We've had that. We'll be illustrating that, some T accounts here in a moment. So I'm not too worried. If you want to look at that, you can. So here in E, here's where we have the example of job order costing journal entries. And we'll assume the following occurred during a month. Now, the first thing is that we have beginning balances of $3,500 in materials control, $2,700 in work in process control, and $3,900 in finished goods control. And I will explain that to you. Let me come back live on screen. Okay. All right. So what we do whenever we have T accounts is that we're going to keep a running balance of what's in that account. Now, you'll recall that we had two types of accounts. One was called a real account. Another was called a nominal account. A real account has a balance which carries over from one year to the next. A nominal account is zeroed out at year end. So real accounts are going to include those that are on the balance sheet. So any asset, liability, or equity account. A nominal account is going to include any revenue or expense. It's on the income statement. It's zeroed out from year to year. Well, if we look at these three accounts, materials control, when it's called out, I'll explain why in a second. Work in process control, finished goods control. These are each inventory accounts. So their balances carry over from one year to the next. These balances are at the beginning of the year, and they must have been last year's ending balances. So these are the inventories we had left over. We just have to make sure they're in a T account so we can start keeping a running balance. So the first thing is materials control, which is the usual title in most books for direct materials inventory, just to let you know. So here with materials control, if I were keeping a T account for it, I would make sure it's set up at the beginning of the year. Because this has a real balance at the beginning of the year, a non-zero balance. It's called control because it controls a whole bunch of different types of direct materials. This is our inventory number one. We've seen. So $1,500 is the beginning balance. Just going to put a little one there. This comes from entry number one. Then the next inventory we have, inventory number two, is work in process. Again, most terms attach the term control to it because it controls a whole bunch of different types of items on the assembly line. And it's inventory number two in time. So $2,700 debit. And then finally, finished goods. Inventory number three in time. And balance finished goods inventory once again was $3,900. We'll have our flow of costs from materials control all the way through finished goods control. Just we've had before on the assembly line. I'm going to go ahead and put a fourth T account up here because I know I'm going to need it. Make sure this appears on screen. It's going to be cost of goods sold. Because as we think about our flow of costs along the way here, once finished goods are sold, well, they're no longer assets. We no longer own them. Instead, they're going to be expenses. So that these costs will transfer from finished goods to cost of goods sold. And of course, I will show you in journal entries in just a bit. All there on screen. Again, as you know, you've got that additional handout there. So you've got all the numbers. Now, let's come to the second thing here. And we've got that we're going to purchase $8,000 of direct materials and $1,000 of manufacturing supplies, also known as indirect materials. Things like cleaning supplies for the factory, Well, as it turns out, this materials control account includes both direct materials and indirect materials. So what we're going to do, I make my first journal entry here. I'm going to debit all these to materials control. Now, some books will have two separate accounts. One will be direct materials control. The other will be indirect materials control. Your book doesn't. So they combine these into one. Most cost accounting books do. So as I have my journal entry, number 2, I'm going to be debiting materials control. Again, we bear in mind this is an inventory account. It's an asset. So that debit of the total of $9,000 that they're purchasing just did what? The balance materials control. What did we just do? Yes, we increased, so we debited that. The credit is going to be to accounts payable or rarely to cash. Usually it's going to be charged, so it's going to be to accounts payable, but once in a great while, it could be cash. Doesn't really matter for our purposes, so I don't really care about that. I'm just caring about the manufacturing related accounts. So let me just go ahead and put in accounts payable for convenience there. I'm not even going to post that to a T account because I'm so unconcerned. Then let me go ahead and post this, or at least the debit part of it, just the manufacturing related account. That'll be materials control. I'll be journal entry 2. And again, $9,000. Then in number 3, back there on the handout, we're going to use $7,000 of direct materials and $400 of manufacturing supplies. So as we use these, we requisition them to the assembly line. We're going to put them into work in process. So let's think about this journal entry. This one here is going to have 2 dates. So let's think about that. Maybe I should actually do the credit first. This journal entry is going to have 3 lines. It's called a compound journal entry, which means it has more than 2 accounts. So with this journal entry, we have 1, 2 blank lines, 3rd line indent. So that'll be indented for the credit. Notice that we're using a total of $7,400 of inventory out of materials control. It comes out of materials control, and I'll go to a couple of places. One place we'll go is on over to work in process control. So let's debit work in process control for $7,000, only for the direct materials. So I just did what to work in process control by debiting it. Did I increase it or decrease it? Increase it, you bet. Then for the $400 of manufacturing supplies or indirect materials, that's going to be a part of overhead. just like any other indirect cost. Just post slash H and that'll be 7,400. I'm sorry, that'll be $400. Which sure enough makes up the full 7,400. By doing that, I've introduced a new account there, the overhead account, which is a very, very nominal account. It's only to keep track of the total amount of overhead. And you'll see how we close out at year end. We zero it out. And it's, like I said, very nominal, just keep track of all the overhead items we're going to have. Apologies if that didn't quite all be on the screen there. Then let's go ahead and post that. There in journal entry 3. I'm going to be crediting materials control for 7,400. So I just reduced it. I just took 7,400 out of there. It's going to go 2 places. One place will go will be 7,000 to work in process control. That way we've traced the exact amount of direct materials we use to work in process. Like any other direct cost. So it just kind of flowed along to work in process control. Then I'm going to need another account. Need to introduce this overhead account in the form of a T account. I'm going to go ahead and debit that for 400. So the 400 moved on along to overhead. Keeping track of the amount of overhead we've incurred. You'll see what we do with that year end. Any questions so far? Now, journal entry 4, back on the handout. We're going to incur $10,000 of direct labor, including fringe benefits for direct labor workers, and $2,000 of indirect labor. So with direct labor, your book does it a couple of different ways. I'm going to do it the simpler way. The other way just involves another journal entry, although it's easy. But I'm not going to worry about that. You may see it in your homework and that's it. So let me do it the easier way with you. So as we have the $10,000 direct labor and $2,000 of indirect labor, people like supervisors or maintenance workers. We make a little bit of room here. Otherwise, if I start going too far on over here, well, I'm not going to be able to get a very good shot there with my camera. So here in journal entry 4, let's count for direct labor first. We have to be very careful where we distribute that. It's a direct cost. So like any other direct cost, it's going to be distributed or placed into work in process. $10,000 is right there. Then, when it comes to the indirect, like any other indirect cost, it's part of overhead. So we'll debit that to overhead, 2,000. Then, to make that journal entry balance, by the way, debits always equal credits, remember that. To make that balance, we're going to be crediting $12,000 for wages paid. Usually not cash, they usually wait until later to pay cash. Payday's a little bit later. So now we've increased work in process by 10,000, direct labor. We've increased overhead incurred by 2,000. Let me go ahead and post those. Got that. Journal entry, camera. Okay. Now let me aim the camera on over my journal entries. Sorry, my T accounts. So here in journal entry 4, I've debited or increased work in process by 10,000 direct labor. And I debited or increased my overhead costs incurred by 2,000. The credit to wages payable, I'm not really worried about. It's not really manufacturing related. Then, if we look at journal entry number 5, it's payday. So that means our workers want to get paid. Here's what we do on payday. But bear in mind, we've got wages payable there. Balance of 12,000 credit, as we would expect. So now we're just going to reverse that. Get rid of wages payable. Pay our workers off. So debit wages payable, 12,000. And for the offsetting 12,000, well, what do our workers want? Which account? Cash. If we pay them, we will do what to our cash balance? Credit. And if we credit cash, well, there's our offset. So good, we paid our workers off. They'll be happy. Then let me go ahead and post the, or actually I don't have to post anything. If I wanted to, I could post a wages payable and T account up there. It doesn't really matter. Again, I'm not very concerned about it. Oops, there go the lights. Then journal entry 6, we're going to incur an additional amount of overhead of $5,000 from miscellaneous sources. So it could be from insurance payable, it could be from property taxes payable in the factory, it could be from overhead on the factory building and factory equipment, et cetera, et cetera, et cetera, whatever it may be. The only thing I'm really concerned about there is going to be the debit, because we're going to be debiting that to this overhead account because another overhead cost we've ignored. Let me go ahead and make more room here. So here we're going to be debiting overhead to increase it 5,000. And as far as credit goes, I could just put various accounts. Again, 5,000. There's what that looks like. And over here, I'm going to be debiting overhead by 5,000. Then number 7, we went over this one the other day. I'll refresh our minds here. We're going to be allocating overhead production. And as we allocate overhead production, we assume the overhead is applied on the basis of budget annual overhead of $75,000 and budget annual direct labor cost of $200,000. Overhead is normally allocated. Don't worry about that. Okay, we're just told to allocate overhead, so let's do it. We bear in mind that here in number 7, myself place on the board as we look at the predetermined overhead allocation rate. What's going to equal? It's going to equal $75,000 of overhead that they budget. Predetermined, we're setting it up at the start of the year. Divided by the cost driver or allocation base, which is $200,000 of budgeted direct labor cost. So again, as we saw the other day, we get a rate of 37.5% of direct labor cost. So now, as we allocate overhead in journal entry number 7, well, we're going to take, let me leave 2 blank lines and come down and compute a number. We're going to take the amount of direct labor going into this job, 10,000, and multiply by 0.375, 37.5%, same thing. So that gives us $3,750 of that overhead to allocate. So we debit and credit. The question is, which 2 accounts? Well, first of all, the debit. Here, we're finally going to increase work in process. You can put control if you want. I don't care if you really do or not. That's when we finally increase work in process for overhead. We've increased it so far for direct labor and for direct materials, and now it's time for that third input to manufacture of overhead. That increases work in process. The credit is going to be to this very temporary account called overhead. Questions so far? Let's go ahead and post that. So we just increased finished goods by $37.50 from journal entry number 7. And we're going to credit overhead in that same journal entry 7, $37.50. And you're right, the two sides should really equal each other, but they usually don't. So we'll see how we account for that in just bits. It's easy. Then journal entry 8. We're going to transfer $20,000 of completed product from work in process to finished goods as it rolls off the assembly line. So if we add up the job cost records of the jobs that were just completed, they total up to $20,000. That's where that came from. And journal entry for it on over here. So this journal entry is very easy. It's just like out with the old, in with the new. So it's going to be out with the old finished goods and in with the new, out with the old work in process, in with the new finished goods. So here in journal entry 8, I'm going to debit that finished goods account, finished goods control if you like. I'm going to be crediting or reducing work in process. The amount is $18,000. Here to my T accounts. What I'm going to do is take the 20,000. Pardon me. Come back over here to the journal entry. I made a posting error. Easy to do. I was looking down at the next one where we're going to sell $18,000. No. For now, we complete $20,000 for it. So please correct that. There. As auditors are auditing companies, how often do you think they find posting errors like that? Constantly. Very easy to do. All right. So, out with the old. That means out with 18,000. There I go again. Once you make a posting error like that or any other type of error, how easy is it to repeat it? Very. So we'll take $20,000 of completed product out of work in process. So out it comes, it reduces work in process there with the credit, and it's going to flow on over to finished goods. Journal entry 8, 20,000. Then finally, we've got journal entry number 9, where we sell $18,000 of finished goods. Journal entry number 9, again, outfield in with the new. This time it's in with the new cost of goods sold. And outfield finished goods. We no longer own finished goods, so we reduce finished goods inventory by the 18,000, and the flow of cost just goes on over to cost of goods sold. Cost of goods sold increases, it's an expense with that debit. Here's 18,000 and a journal entry. And now as I swivel my computer back over here, between my camera on the T accounts, we're going to take 18,000 out of finished goods, and we'll move that cost right on along cost of goods sold. Debit cost of goods sold, it's expense, so that's going to increase it. Okay. Any questions there on journal entries or T accounts? Or things seem pretty familiar from back in 2111? Good. So seem pretty easy. They're not bad. Yeah, not nearly as bad as all the endless journal entries in 2111. So I think you'll do fine. Well, next thing we have to clear up is this question about overhead. Let's assume it's year end. Yes, indeed. The balances of these two sides should be equal. Debits should equal credits. So the amount of overhead that we've incurred here on the debit side should equal the amount of overhead we've allocated here on the right side. But since overhead, the allocation rate really is an estimate, it's based on the budget at the start of the year, it's not going to equal unless it's a bizarre coincidence. And in that case, it's time to play the lottery. So let's see what we're going to do here to clear this up. So let me come back to my handout. Share my screen again. So here in F, over and under allocated overhead. So we're now at year end. The balances of overhead control and overhead allocated. By the way, the debit side is often called the control side, and the credit side is often called the allocated side because that's the amount we've allocated to production. So they should equal each other, but they don't. Well, this may be because budget overhead and actual overhead incurred did not equal. The numerator reason, because that's where we had those numbers as we figured out the overhead allocation rate, or because the budgeted quantity of the cost driver did not equal the actual quantity, which in this case is going to be the denominator reason, because those will be the figures we have the denominator of the overhead allocation rate. Well, we can note that we're allocating overhead under normal absorption costing, which means the predetermined overhead allocation rate, it uses the predetermined overhead allocation rate rather due to timeliness. Actual absorption costing would have waited until year end to allocate overhead and would have caused overhead allocated to have exactly equaled overhead control. And under GAAP, our account should approximate actual absorption costing, and that's in accordance with the historical cost principle. So this is one of the very few places in this course where we're going to have to worry about GAAP. We're going to have to worry about GAAP because, well, these numbers are going to come out in external financial statements in the end. So we've got to work our way back to actual costing. We've got to act like we waited until year end to figure out the overhead allocation rate. And we have to act therefore like we have exact numbers and we don't have any under or over allocated overhead. So we have to close overhead control and overhead allocated out to each other year end and dispose of the difference. There are 4 ways to dispose of the difference. We're only going to handle one in this class. But if you take upper division cost accounting, you'll handle the other 3 way. So I just want to make sure that I include those here for you. So 4 ways to dispose of the difference, but again, we'll only do A. We're going to write it off or plug it to cost of goods sold. And that's quick, but it's the least desirable way. Let me show it to you. Come back. So let's see what we have with this overhead account. So I just reproduce down over here. This T account. We have a total of 7,400 there on the debit side. And we have a total of 3,750 on the credit side. So this 7,400 is the amount we've incurred and the amount of 3,750 is the amount that we've allocated. So ideally they should have been equal, but they aren't. As it turns out, we have a balance here of 3,650 debit. We did not allocate enough. So we say it's been underallocated. And again, it's just because this overhead allocation rate was based on budget figures. It was an estimate. So we've got to get rid of that 3,650. We've got to do so because this is a nominal account. It must be zeroed out at year end. So we close it out. So recall that closing process for 2111. Close it out just like any other nominal account. We're going to zero this thing out. So if we're going to zero this account out, all that there on camera. So if we're going to be zeroing out this underallocated overhead, what should we do to zero it out? Debit or credit? Credit, you bet. We're going to be crediting it for 3,650. Try this other blue pen up here. That's no better either. Yeah. I'm just going to put black. There we go, 3650. We'll credit this thing. And when we do, that brings us to a balance of 0 at the very year end. Oops. Can't quite see that here in the classroom. I went ahead and credited overhead for 3650, leaving us with a 0 balance. In this case, overhead was underallocated. It could have easily been overallocated too. In that case, would have been exactly the opposite of this. What I'm really concerned with, though, is if we can make the journal entry and close this out. So in order to make the journal entry and close this out, we're going to be, it's right here. We're going to be, excuse me, of course, crediting overhead, 3650. But the debit is going to be written off cost of goods sold. Plug it to cost of goods sold, in other words. Plug just means whatever figure you need to write off, do so. So the closing entry there, just you have in your notes, debit cost of goods sold by 3650 and credit overhead by 3650. That's going to be increasing cost of goods sold. The theory behind that is that we did not put enough overhead in cost of goods sold. So cost of goods sold is understated. Therefore, we're going to increase it now by 3650. Everybody with me on that? Now, of course, that blames everything on cost of goods sold when really overhead flowed through work in process and finished goods as well. We're not blaming anything on them, but if we had done this the 3 other ways as well, the 3 optional ways that you would cover in cost accounting if you took it, that's when those other 2 accounts would also get blamed. They would have gotten a chunk of this debit. For how much? Well, we'd figure it out then. But I'll leave that to cost accounting. Any other questions?
What is your journal entry when the account is over?
Sure. If it's underallocated, it'll be just the opposite. We'll debit overhead and we'll credit cost of goods sold. And that's going to decrease cost of goods sold. Okay, just a little bit more here to finish up. Okay, job order costing for the service sector. Basically, I'd like for you to know this. I can sum this up. Yes, indeed, we do want job order costing in the services sector. We have a service, we don't have inventory, but we have something such as a new software program that's been developed. Even though there is no inventory, no direct materials that is going into that, there are still very, very significant costs when it comes to direct labor and to overhead. So we can certainly apply job order costing in the services sector. We just wouldn't have any inventory, but we still have direct labor. We still have overhead. And that's it for the chapter. Any questions there on the chapter? Okay. All righty. Well, that's what I've got for you today. So have a good one, and I'll see you back on Thursday. Bye-bye.
Thank you.